Welcome to another episode of Coffee with Alissa. As we continue our series featuring our advisors and how we can add value to our client relationships, I'm going to be interviewing Matt Biggs. Along with advising clients, Matt holds his Chartered Alternative Investment Analyst designation and is a part of our investment team, focusing his research on private investments. So thanks for joining me today, Matt. How are you?
I'm good, Alissa. I'm excited to be on my first official appearance on Coffee with Alissa. So thank you for having me.
Well, let's dive in. So private markets, there could be some really interesting investment opportunities here, and a lot of them aren't accessible, of course, via public markets. That's why they're private. So can you start out the video by giving a broad overview of some typical investments in this area?
I think in general, like the way you just said it is the way I think is the easiest way to think about it is, it's private equity or alternative investments, debt or equity that cannot be accessed through traditional public market channels. So, as far as what that entails, so there's lots of different asset classes kind of underneath the private equity umbrella. Venture capital is one that most people, kind of immediately associate with private markets. And those are typically startup companies with limited access to traditional financing. So they'll raise money through private markets. Real assets is one, that I think people are somewhat familiar with. That includes real estate, timberland, farmland, infrastructure, intellectual property, natural resources, the list goes on. So, real assets, there's a plethora of things that fit under that, all the way to things like leveraged buyouts. An example of that would be, taking a publicly traded company private. So that is three short examples, and there's probably hundreds that I could give. But just know, the easiest way to think about it is it kind of how you introduced this question is it is, assets that you cannot access through public channels. And I think, as far as the asset classes, they span on and on and on, but that's in general the best way to think about it.
Great. So when you think about just the available investments in the in the public markets, there are a lot of ways to invest, a lot of things to get involved in. So why invest in private markets if we already have all of those types of investments available?
That's obviously a question we get from a lot of the people that we work with is why would we do this? I hate to boil it down to just one thing, but in my simple mind, I think of returns, right? So what is your expected outcome of this investment? And returns is something that we would expect would outpace public benchmarks. So, by going into private markets, you're losing some liquidity, right? And for that, you should be rewarded with a liquidity premium. Basically, you're locking your money up for extended periods of time. So why would you do that if you can't outpace public markets? You wouldn't, right? You wouldn't do it. So in a simple one-word answer would be returns. We would expect that the private investments that we are helping our clients get into should outpace their public counterparts.
So you mentioned, some illiquidity lockup periods, right? Are there any other limitations that come with investing in private markets?
Liquidity is probably number one, right? That is, you have to be able to stomach, locking your money up for 5, 7, 10 plus years for some of these investments we're doing. So that is the first thing I think of where it's what would be a drawback? It's, hey, you have to be willing to give up some liquidity on your portfolio. The other drawback would be there's typically higher entry costs, right? So they're called private markets for a reason because they are harder to access, meaning your initial cash outflow, is going to be sometimes the minimum is anywhere from $100,000 to upwards of $250,000 minimum to invest in a private investment vehicle. Now, the way that the traditional kind of private equity vehicle would be a capital drawdown, meaning it's not like you are necessarily having to write a $100,000 check on day one, right? It's slowly drawn, that capital is slowly drawn over a 3-year period, but you still have to have the liquidity to be able to fund that investment over that 2 to 3 year period. So the other biggest, downside would be, yes, you have to have enough money to actually qualify to invest in one of these. The the last thing I would think of is, and this is just something that when people are used to investing in public markets, right, they know, hey, I'm going to log into my Schwab account, my Fidelity account, whatever it is, at 4 o'clock, 5 o'clock, 6 o'clock in the night. And I know what my balance is going to be based off that day's trading activity. And that's not how private markets work, right? If you think about it, it is, think of a fund that has all of these private companies held inside of it. There's no one buying and selling these companies day in, day out. So they're typically priced quarterly. So you're really only going to have quarterly performance. And a lot of time it lags because these have to be audited. So, you might not know your 12/31 values until, March. So that would be another drawback is you've got to be able to be willing to, give up some of the transparency on the daily basis for quarterly transparency.
Yeah, all really good points. And I think along the lines of, having the liquidity to be able to put forth, some of these entry costs, which can certainly be high. The two things come to mind. One, you need to be an accredited investor. So I'm going to ask you to explain that, but also, you probably don't, unless it's a fund that holds several different investments, it's probably a good idea, just like any other public investment, right, to diversify your portfolio. So really being in a position to be able to have a diversified portfolio, I think, is important too, versus putting all of your eggs into one basket. But if you could so if you want to touch on that, you can, but just touch on the accredited investor piece.
Accredited investor, it's a minimum amount of income. So, filing individually, $200,000 in income, filing with a spouse, $300,000 in household income, or $1 million in net worth. So in order to meet the accredited investor criteria, you have to kind of mark one of those boxes.
So how do we help our clients evaluate whether private investments are a good fit for their portfolio? And then if we decide, hey, this is a good fit, how do we help them design that portfolio and move forward?
That's a good question. I think, as you know, every client is unique. So it starts with the first conversation of would it make sense? And before we're even bringing that up to a client, right, we probably already know the liquidity issue is, do they have the ability to be illiquid with some of their money? So that is the first box we check, right? Like, okay, or if you have the liquidity, we're okay committing capital for longer periods of time. Great. Now let's move on to to the other boxes that we need to check. The next one I would say would be from a risk tolerance standpoint, right? So these are private vehicles. While they're not, they're not marked daily, so you're not necessarily seeing all the volatility every single day, but they are still risky investments. They can still go up and go down just like traditional public markets. You just don't feel it as much because there's this smoothing effect when you only, price your assets every quarter. That said, it's still a risky investment. So we want to make sure from a risk tolerance standpoint that the client is still okay with that. Does this investment fit their risk tolerance? And then I think last, so if you're able to lock up the money, right, you're fine with the liquidity, from a risk tolerance standpoint, it fits, then it becomes a conversation of pros and cons, right? And is the client comfortable? Because a lot of these investments are hard to understand, and we want to make sure our clients understand what they're investing in. So there's an education period, and then we start to talk about the different types of investments we have inside of private equity. So like we talked about earlier, we have infrastructure investments, we have, real estate investments, we have venture capital, we have secondary, the list goes on. So then it's evaluating with the client, hey, knowing your risk tolerance, knowing your liquidity needs, here's the ones that we think would work for you, and we want to build it in a way that it's working in conjunction with the traditional portfolio. So these are not just a 10-minute conversation, hey, let's go ahead and get you in this. It is a holistic view of knowing your cash flow needs, knowing what the traditional portfolio is doing. Here's where we think private equity could be a good fit. So truly a process, but I think if we have the right fit for the right client, it can be very rewarding for that client.
Well, thank you, Matt. I appreciate you joining me today and sharing all of your knowledge with us. And to our audience, thank you for watching. See you next time.
Thanks, Alissa.